So the big sort of dominant thing in the markets right now is the rise in interest rates. Interest rates are sort of, this is TNX at the 10-year treasury, trying to really break out above the 2021 highs. And right now that's a big driver, and there's concern about it with the CPI out Wednesday. So there's quite a lot of uncertainty and volatility in the markets based on it. The big problem and the thing that the market's really focused on is from the FOMC meeting and from the minutes, huge difference in the dot plot from September versus December. You can see that it's for end of 22. In September, most people were thinking either no rate cuts or a 0.25, whereas in December, the median was at 0.75, so rate hikes. And then sort of the same thing with the end of 2023, another 3 rate hikes that really weren't baked into the cake before. So that's a huge shift in the amount of rate hikes people are thinking. FOMC and the market's kind of freaked out about that, because it was not really consistent with what it was thinking. The thing to understand, though, is that it's really unlikely that the Fed is going to substantially do things because of the situation with employment. And so what we see here is that, first of all, the COVID crash is the biggest drop in employment since the Great Depression. Nothing World War II is remotely close. And even though we've come back at the fastest rate ever, we're still having 3 million people not employed that were employed. That is worse than the trough of about the recessions we've had since World War II. So the job losses are still. So realize that, and then really another thing to sort of understand is that, the Jimmy Carter era where they were talking about the really high inflation and stuff, if you use that same definition for unemployment, we're at 24.5% unemployment by that definition. So this 3.9, if you keep changing the definition to take out people who haven't looked for a job in the last week or two, that changes things substantially in terms of labor participation and actual employment on it for population. We're really not doing very well. This is, I think, a really great chart. We had it in PSL, but I really want people to understand it and look at it. And that is rate. So first of all, yes, markets tend to slow down their growth and they get a lot more turbulent when the Fed starts tightening. And that's likely to happen this year. But it's generally, the market doesn't turn down on a sustained basis, short-term and intermediate-term corrections notwithstanding, but on a sustained bear market basis until the Fed basically hikes rates over market rates. And so if we use the gold here, the 2-year rate, the sort of the market set rate, you can see that, and you can do this every recession since World War II. Basically what's happened is the Fed funds rate has gone above the market rate by about 0.5% or more and stayed above that for many months. And that's really what chokes off the recovery and the entire bull market. We're not close to that. Market rates are way higher than where the Fed funds rate is. So generally what happens is the Fed overly cuts rates at the bottom of the recession, and then market rates begin turning up, and then it has to play catch up. And so it has to hike rates much faster than the markets are going up. And when it overtakes, that's where you really have the risk of a new recession. We're not nearly there yet. And if you look at each cycle has had lower highs in the rates before we've choked off the economy. That's generally because at every single trough, because the Fed artificially cuts interest rates below the market rate, that encourages much more debt than you would have if the price of debt was higher. And so we get higher and higher and higher debt getting it to more unsustainable levels. And that's why we get lower and lower peaks of interest rates before we cut things off. The point to understand here is that, yes, this is going to lead to some volatility. It can lead to some intermediate term corrections, but until the Fed really gets above the market rate, it's unlikely to cut off the recovery unless we have some new Omicron shock or something like that that really does damage to the recovery more substantially. The other thing I think is important is really watch the Omicron stuff. And what we're seeing is what we talked about last month, where it's still the case that, first of all, in South Africa, that's kind of the lead on Omicron. They've had a peak and they've dropped substantially, more than 70%. So they've peaked already. And notice that their death rate and their hospitalization rate is just substantially lower than any variant. So that gives the opportunity, if that continues, and so far it has, that it's not going to have as much of an impact as other variants on, in terms of creating lockdowns and in terms of creating more supply constraint problems and in terms of cutting economic growth. Yes, it will cut some economic growth, but it probably won't be as severe as the last round when we had the Delta variant. So our base case sort of calls for continuation of the recovery, albeit with some potholes along the way, leading to a continuation of bull market in stocks, although we'll have short-term and intermediate-term corrections in that bull market. And so now we kind of go to our cyclical model to tell us, okay, what at this stage of where we are in the recovery, what sectors tend to do well. We're kind of in this period between early and full recovery. And so we see energy, materials, staples, industrials, healthcare, those types of things with financials on the horizon. That's kind of where we are and kind of where we're watching. And we can see breakouts by energy and some in materials. And we can see that financials and large cap value are benefiting from the rising rate backdrop. So those are areas to look at. The other thing that I want to point out is that, yes, we're having a noteworthy spike and a many decade high spike in inflation, partly from supply constraints caused by lockdowns that killed production. And then we still have the high level of demand because of stimulus. And so that high demand meets lower production. And so we've got those things, and some of those look set, not all of them, but some of them look set to come off the boil and are already starting to. So it's possible that we could have this situation that we've had really since Volcker cut off inflation substantially, which is sort of a mid-cycle peak in inflation. So I think we're setting up for at least an intermediate term attempt at that. If that holds for a prolonged basis, what that generally creates is an incredible opportunity for NASDAQ versus S&P, for growth versus value. But we're not, until we're there, growth is going to be in trouble. Small caps are going to be in trouble. But we have a possibility, if we get a peak in inflation that turns down on an intermediate term basis, that growth will make a comeback. And that's something to watch for in the sector rotation during the year. Right now, value is doing much better. It's kind of the only thing holding up. And there's still, because the trend has been down for value for so long, there's still lots of room on the upside in terms of valuations of value, et cetera, versus growth. And you can see how when interest rates have gone up in the past, that tends to show spikes in value. But on a short-term basis, it's getting a little extended, so it may sort of correct or come off the boil a little bit before moving again. Financials breaking out, sort of the highest order of value that's breaking out and benefiting from that. So right now, the markets are spooked because of these rising rates that are trying to break out, and then the Fed change. And then, of course, we have the CPI and some other global inflation reports later this week. So we kind of had a little bit of a spook out. We bounced off this trend line and closed nearly at break even on a lot of the indexes. And then NASDAQ actually closed back above its 200. Looks like it will. So we've had kind of these having a lot of retests. We had this sort of correction over short term right after our last report off the D3 correction lows, but we really didn't get the kind of traction that we would like to see to say on an intermediate term base, we're ready with adding a lot of exposure. So we're still kind of waiting for that. We can see the real problems before the inflation and interest rate hit markets and sort of economic deceleration markets. Small caps, as you can see, have really been sideways since February. And they're retesting this level, and it's kind of bounced off of a little bit today. Really watch this 203, 206 support level in IWM. A clear break below that would be really negative. And then growth stocks. So these are down 15, 16% from November highs. Growth stocks, FFTY, which is IBD 50, down over 22% from the highs in the last couple months. Really negative, but bounced off of the key support level here, 40-50 today. And we can see that the relative strength trend on a point and figure chart basis, we like for it to be up, both short term and intermediate term, to say that we're really going to have substantial outperformance. We're down both short term and intermediate term. So it's a defensive backdrop for growth until we get some evidence that inflation is peaking. So the biggest issue that you want to understand with higher inflation and higher interest rates, they eat into the valuation of growth companies, and especially areas of the market where the values are highly dependent on future earnings growth being really strong. Probably the best illustration of that you can see in the market is ARK, the innovation ETF. That's really heavily oriented towards companies that aren't actually making money now, but have huge growth baked into them in the future. That's what high inflation and higher interest rates really bite on the valuation side. And you can see the impact. ARK is down nearly 50% from its February highs as inflation and interest rates have gone up. So you want to avoid these still until we get some kind of inflation peaking. The other thing that we want to note about this rally, it had a nice correction over signal, but then we really didn't get kind of follow through that we'd like to get, and the participation rate and the breadth participation that we like to get, say, okay, on an intermediate term, it's all go, start adding allocation. We just haven't gotten that yet. One of the big problems is really well illustrated in this that shows the relative strength of the major S&P sectors. And you can see in the top half of the performance for the last month, really since those, which is basically since that correction over signal, you have staples, you have real estate, you have utilities and healthcare, all in the top half. Those are all defensive sectors. And the offensive sectors like technology, consumer discretionary, and communication services, those are actually at the bottom of the. So you need that. That's really weak leadership. It's leadership by defensive issues. What it's showing is there's still flows into the market, but it's going into defense, not into offense. That really needs to shift, and you can see it in our lists. Our lists have had sort of negative defensive leadership indications for a while now, and that's something that needs to shift.